I'm Pastor Aaron Harris, and this channel is all about helping you receive financial literacy. In this video, you'll learn about how to unlock the secrets of smart investing so that you will have financial success in your future. The most known and greatest investor that we have living today is Warren Buffett, and he made his fortune by going out and investing and helping others to be able to invest their money. And although he leads a large investment firm, his recommendation for everyone is that they invest in simple index funds like the S&P 500. Dave Ramsey is an author and a radio show host, and he has helped millions of Americans get out of debt and thousands of people become millionaires. And what he recommends is that people invest in mutual funds that outpace the S&P 500. What's similar about the advice that comes from Warren Buffett and Dave Ramsey is that they are both encouraging us to invest our money into moderately risky investments that have been proven to grow over time. So in this video, I'm going to show you why investing in index funds and mutual funds are the smartest investments that you can make. The most common thing between index funds and mutual funds is that they are both highly diversified. Highly diversified means that all of your money is not going into one place or one stock, but they are spread out amongst different stocks in different sectors. And so what that does is it really helps you to be able to mitigate your risk so that if something happens in one part of our economy, that you're covered by another part of our economy. Have you ever heard the saying, do not put all your eggs in one basket? The reason that saying exists is because if you put all your eggs in one basket, if anything happens to that one basket, then all of your eggs are gone. Instead, if you spread your eggs out against many different baskets, then if something happens to one basket, you still have all the others. And that's how diversification works with your finances. Diversifying means not putting all your eggs in one basket. So instead of just having all your money in real estate or all your money in a technology company or all your money invested with a healthcare company, instead what mutual funds do and what index funds do is that they spread your money out so that if we have a health crisis, you still have money in other places. Or if we have a technology shortage, like we don't have enough chips and technology stocks are going down, then you still have money in other sectors that will be able to help you to continually grow your finances and be all right. So pretty much diversification is a safety net ensuring that even if one part of the economy is suffering, that you will still be able to grow your money. So Dave Ramsey recommended that we invest in mutual funds that outpace the S&P 500, which is the index fund that is recommended by Warren Buffett. Now, if you know a lot about stocks and investing in mutual funds, then it may be easy for you to look at which mutual funds have outpaced and outperformed the S&P 500 over the past 30 years. And you can put your money into that, and then hopefully you can beat the S&P 500 by 1% or 2% each year, which will give you more money. But for people who doesn't know that much about the stock market, a better bet may be to just put our money into an index fund like the S&P 500. One thing I like about the S&P 500 index funds is that I can put my money there and I don't have to worry about what the mutual fund is doing or what's going on, because every news channel, every newspaper is going to tell me what's going on in the S&P 500. So I'll always know where my money stands. Index funds like the S&P 500 are considered moderately risky because they go both up and down, meaning you can gain money and lose money. But that's only in the short term. Over a long period of time, anyone who has invested in the S&P 500 for a long period of time has never lost out on their money. So if we're investing for 30 years, 40 years, 50 years, right? If we're planning our retirement, then investing in the S&P 500 is pretty much as close as we get to a sure bet when we're talking about making a good investment. Some people say that they want to put their money in a low risk investment. Low risk investments are good if you're trying to protect your money when you retire. But if you're really trying to build wealth and build money and gain more money, then you really need a moderate risk investment. Low risk investments get you usually between 2% and 5% return on your money, which barely outpaces inflation. So when you're looking at the rise of cost of living, then moderate risk investing is really the way to go. Then you have some people that want to put all their money in high risk investments. But the reason you don't want to put all your money in high risk investments is because they are highly risky and you can easily lose all the money that you have. High risk investments are things like individual stocks which are not diversified, or when you leverage an investment, meaning that you take out debt and you invest with the debt that you've taken out. Historically, index funds and mutual funds have given us about an 8 to 12% return on our investment. So if you're looking at an investment like the S&P 500 index fund, then that has historically gave us about a 10% return annually. So the secret of smart investing is not to go and try to do something that has never been done before, or follow someone that says they have this brand new recipe that no one knows about that's guaranteed to make you money, which in reality is probably going to lose you a lot of money. Instead, is to look at what historically has gained people a lot of money. And index funds and mutual funds have historically given people great returns. And that's why most of our retirement funds are tied up in both mutual funds and index funds. And many people will promise you that they can give you returns that will outpace the S&P 500. The only thing is those returns are not guaranteed. And when you factor in the fees that they're going to charge you for their services, then oftentimes it's just easier to just put your money into the S&P 500. It's easier, it's smarter, it's wiser. You know what's going on, where your money is going, and you're not just trusting a random person. So if you want financial success, then don't go out and try to do anything brand new or try to be a genius. It really does not take rocket science, but there are some tried and true methods that have been working for decades and will still work for you today. So if you enjoyed this video, then watch my next video, which is all about investing.